Well, Sanjay Dutt of Quantum Security joins us now. Sanjay, fantastic to have you back on. Thank you for joining us. Now, what a market, or what a Monday it was. The best performing stock collapsed, cracked by 10%. The biggest underperforming name, Bharti, came back by 5%. But what was even bigger is that the biggest underperforming sector, which are private banks, they made a roaring comeback. So Sanjay, are we at that turn? Are we at that big turn where the stacking order of underperformance versus outperformance, the stacking order of market performance versus market performer versus market underperformer is likely to change?
It's too early to say that, Nikunj, are we at a turn or not? But one thing is very clear that for calendar 2021 and FY 2022, definitely the economy is on the mend. Things are picking up. And more inward-looking industries are looking very positive. We've already seen a substantial run-up in sectors like tech, pharma tech, particularly obviously is dependent on overseas business. But domestic business does definitely showing signs of a clear pickup and stabilization in FY22. And we must understand the underlying point, and that's why we saw the rally yesterday, that interest costs for the industry as a whole, for the economy as a whole, are just collapsing. We haven't seen levels, I think, in the last 2 decades as low as what we are seeing now and what we'll see ahead. And definitely liquidity is there in the system. Both Indian as well as the foreign central banks are not letting go of the liquidity. So therefore, economies like ours, where there is growth, where there is the demographic benefit and there is a growing economy, I think what you correctly said, it might just be the inflection point and, the disconnect in the market between what was going on earlier and what lies ahead for different sectors.
If you have to choose between, let's say, HDFC Bank and ICICI Bank, it's a difficult choice because one is consistency, other one is value for money. Which way would you lean?
Difficult choice. I think it's a very obvious and easy choice. It's time to buy ICICI Bank and have it in a portfolio for the next few years. At a market cap of about, I think, 280,000 or 290,000 crores, with just investments in its key strategic businesses valued at about 70,000-80,000 crores. You're getting the banking business at 1.7-1.8 lakh crores. And with this kind of a branch network and the kind of stability and cleanup that's brought about in the business in the last few years under the new leadership, I think it's a no-brainer. And HDFC with a market cap of about close to 8 lakh crores, both in terms of price to book parameters and all other parameters, there's no reason why you shouldn't choose ICICI Bank over HDFC Bank in your portfolio, at least for the next few years.
Sanjay, historically, if I look at Indian companies, they had 3 factors which contributed to their profitability. It was rupee depreciation, it was inflation, and let's be clear, Sanjay, some companies took advantage of crony capitalism. A lot of these factors are things of past now. Inflation is low, rupee depreciation may not be all that large like what we've seen in last couple of years, and crony capitalism, guess what? I mean, that's got arrested thankfully in the system. So how would you now judge companies, and which companies do you think will be able to survive the new normal?
Nikunj, I'm very clear that in the next decade, companies which have robust technology front-end platforms, number one, companies that are primarily catering to the domestic market and where import restriction or import impracticalities or impossible to import things like near impossible to keep importing cement, and companies which have kept their debt very low and have managed their debt equity and have survived this whole storm, or it's a nightmare over debt. Just look at these 2 parameters, and companies obviously which have been giving positive ROCE and ROE for the last 5-6 years. They're no-brainers, and it's very easy to find them across sectors. So there are no specific sectors. In worst of sectors, you'll find spectacular companies. So I would just take 3 parameters. Companies which are got modern technology as their front end and are reaching out to consumers and are cutting down their costs because of technology. Companies that are domestic facing, which will rely a lot on domestic consumption themes, whether infrastructure or otherwise. And companies which will benefit hugely from the interest cost and have manageable debt. Because to me, the single biggest kicker for equities has always been very low interest regimes for times to come. And that is where exactly India is heading into. So just look at these three parameters with individual micro parameters on ROC, ROE, etc. for companies, and you'll have winners in your basket.
Sanjay, would Bharti fall at all in this category or not quite?
No brainer, Aisha, because it qualifies the first because it's a technology-driven business. It's will be at the forefront of all technology solutions that industries will use because of internet, bandwidth, AI, cloud, whatever have you may. Everything will be dependent on Bharti. Even today, Bharti, in my opinion, is the best telecom operator amongst the 3 or 2.5 that we have in the business. And the beauty of this company is, or I would say the marvelous model of this company is that it has survived the onslaught of the regulatory regime. It survived the onslaught of the largest competitor who threw money at this business, that's Jio, and it's still coming out strong. It's got the highest active subscribers as a percentage to total subscribers even today. And now with ARPU going up and the telecom mess being sorted out, I don't see any reason. In fact, it's the only pure play telecom internet play in the country because you can't play Reliance because you don't have a pure play listed play. And Vodafone has got its own issues to sort out, which will take a little time. So I think it clearly fits into what I said. And it's catering to the domestic market. That's another parameter I said. The huge unaddressed domestic market is still there for it.
Sanjay, then why this kind of underperformance in Bharti? I mean, barring the last 2 trading sessions, even after the earnings, that gap up got sold into.
I saw a very interesting tweet yesterday. Someone tweeted saying that Bharti was 433 rupees in 2007-2008 and it's 433 rupees now. So my reply to that tweet to the gentleman whoever tweeted was that who are the other guys who are alive today? Where's Reliance Com? Where's Etisalat? Where is Telenor, Uninor? Everyone is vanished from the face of the country. Bharti is the only one living. So if you want to, really look at survival and returns, if you had invested in telecom space, this is the only company where you would have your capital safe and even not got a return on capital. In others, for instance, the Reliance Com, you would have bought Reliance Com at 700 or 800 rupees and would have nothing today. So you can't play these kind of companies on 2 months, 3 months, 6 months and say, from 500 it's come down to 400 and, I'm losing money. Yesterday it was 430, then day before it was 488. These are companies to have in your portfolio and watch them over a decade, watch them over 5 years. If you want to buy a company like Bharti and just keep looking at the price on a weekly, monthly basis, forget it. That's not the stock for you. Go to the Delta Casino and play a game there.
Okay, what about the consumption theme as well? And I refer more to the likes of your auto companies, for example. Even I want to throw in a retail, discretionary. I mean, in the sense, given all these signs of a pickup that we're observing, the data coming in, and upbeat commentary, would you be focusing on that, or do you still feel perhaps that a clear revival is still some time away?
See, I can't gauge what's going to happen to the consumption theme, whether discretionary, non-discretionary, over the next 30 or 45 days or 90 days. I only play this theme based on the moat that each company has. For instance, look at the brands some of the companies have. Even today, it's not listed, but I'll just give you an example, a company like Parle. That Parle G biscuit, you can even go up to the caves at 25,000 or 20,000 feet and still find a packet of Parle G biscuit. And the same thing applies to Maggi noodles. So the entire consumption play is going to be something which is where you've got a very strong franchise of brand. And the best part that's happened to them is actually COVID-19. You would be surprised because all these companies have tightened their belts, aggressively cut their costs, whether in terms of supply chain, manpower, etc. But their sales are going to bounce back to the earlier normal levels. So the brand pull that they have, companies like Dabur, Nestle, Hero, whether you look at auto or otherwise, they are going to be the real winners now. The rest, weak hands have been shaken out. They'll not be able to survive. Or, in fact, the most interesting part is look at the paint industry. The entire Asian Paints business basically runs because the working capital is funded by the smaller players like Shalimar Paints. If you go and ask a paint dealer or distributor, he gives cash or he gets very little credit from Asian Paints, and he stretches Shalimar's payments to 3 or 9 months or even 6 months. So therefore, he's playing on the working capital of a Shalimar Paints, which is a non-existent player in the business, and actually he's selling Asian Paints, which has got top-of-the-line pricing and top-of-the-line brand recall. So this is the game. The game is going to be people who are going to have brands in the forefront, phenomenal franchises, who've learned the curve, and who now laterally expanding their product profile. I heard the Asian Paints CEO yesterday, and I was very impressed. I'm not saying that you go and buy Asian Paints today and tomorrow it's going to start going up 10%. I don't know. It may go down 20%. But do I want to have an Asian Paints or a Nestle or a Dabur in my portfolio? Definitely yes, for the next 5 years. Now, when do I time by buying? That's a different ballgame altogether. Do I time it when the market collapses or whatever? I have to figure that out. I have to stagger my buying, or I have to just understand when to buy, because that's a very difficult decision at times, given the volatility in the market.
Sanjay, I go back to that whole thesis with a lot of market men currently are advocating. Buy stocks which are cheap. Buy stocks which are available at a dividend yield. They are low PE stocks. You're buying them at a bombed out cycle, and when economy will come back, some of these stocks will start flourishing again. But after years and years of waiting, a NTPC, a ITC, even a State Bank of India has not only destroyed wealth, it also has led to significant amount of portfolio underperformance. How do you think these stocks will come back? I mean, is one better off realizing that, look, these are passé businesses now and they will be biting dust for a long period of time, and one is better off, amputing them from the portfolios?
It's a very difficult broad brush statement to make and, put everyone in the same basket. You'll have to look at individual opportunities. For instance, I'll give you an example in a PSU space, a company called Gas Authority, GAIL. It's been beaten down to nothing. But you ask anyone who's in gas distribution or who's got anything remotely to do with the gas business, and he'll tell you that nothing in the business you can do without GAIL. So therefore, these kind of companies will come back. Similarly, State Bank of India. State Bank of India may not give you HDFC Bank return, but do remember it's the State Bank of India which ultimately came and helped Yes Bank. Yes, we'll go and say as shareholders, I'm not in the business of doing social service. I don't want to be in a company which is going to do social service for the government of India and do heavy lifting. But understand, these companies do an essential part. I'm talking about particularly the government companies. Now look at the other value companies. I'll give you an example of underperformance. For instance, you go back and see how Reliance Industries performed between 2013-14 to about 2018. From about 900 to 1100, the stock did nothing for 5 years. And look what the stock did in a span of 12 months. So you don't know when this whole value turns into a real, growth engine and kind of gives you that 5x return or 4x return. But you must understand that two important parameters that I use when I look at buying value. Whether that industry has the potential, has growth ahead, is the industry dying, is it going through a structural change that none of these values are going to come back and this value will turn into deep value, or this industry has potential and this particular player has the ability to stay on and will scale up when the industry grows into a growth phase. That's when I want to buy value. So it's very different. Like I started the conversation, you just can't paint them with the same brush. Find value in players where you think the industry has growth and the industry is not dying because of structural changes or because a full lifestyle change or consumption change that is happening the world over. And that test is very difficult to pass. It needs a lot of research, vision, and a lot of brainstorming amongst people who understand markets and who understand industries. It's a very difficult task, but it pays you huge returns if you do that versus growth of momentum, where you can ride it very easily and buy the high price and keep riding them till you have to jump off one day. And we saw the same thing in pharma. For 3-4 years, we all held pharma stocks, nothing came out. And suddenly 1 year, look what's happened. So there is no one size fits all in investment, actually. That's what one has to understand.
Well, Sanjay, we are speaking to you at a time when Diwali is around the corner, and like they say that traditions don't change. This time we are celebrating Diwali over the Zoom, but let's not change the tradition of getting a Diwali idea before we wrap.
I think we're still 10 days away. Tell your guest relations people to call me, and I'll be more than happy to identify a Diwali idea and share it. Offhand today, I don't have anything which I would really call a Diwali idea. There are a lot of ideas, a lot of things, in fact, around the theme that I spoke of. But one stock, I don't think I can think of anything, but a good large cap, like I mentioned, could be a Diwali idea also, and worth investing could be ICICI Bank. But I'm not too convinced whether it's a Diwali idea, but I think it's a good investment idea. And I don't have any positions in it. I'm myself spending a lot of time studying it. And I would look for a bad day in banking stocks to buy it. But that could be a good pick amongst the large caps, liquid names to have in your portfolio for the next 2 to 3 years. I think ICICI Bank will give you phenomenal returns. Something may not be like HDFC Bank or may just be like HDFC Bank, but definitely way better than the banking sector overall.